Hey guys, today I'm going to be sharing with you how to pay yourself as a director of a limited company. This video is ideal if number one, you are already a company director in the UK, or number two, if you are an employee and you aspire one day to become a company director, perhaps running your own business or your own side hustle, that sort of stuff. Or if you've got a relative or a friend who runs a limited company as a director, but who always wonders how best should they pay themselves from their limited company profits. Today I'm going to be diving in and exploring all of that. We're going to cover three scenarios on today's video. Number one is, should you pay yourself a combination of dividends and salaries? That's the first scenario. Second scenario is, should you pay yourself pensions? What if you pay yourself pensions from your company and combine that with dividends and salaries? Is that much more tax efficient for you? And finally, what if you just focus on just paying yourself just a salary? How do those three scenarios work out specifically for you? Today I'm going to be unpacking detailed scenarios for you to be able to make the best decisions for yourself. Everything I'm going to be sharing today is 100% legal. I'm just going to be using the information that's freely available publicly, but essentially sharing with you the kind of stuff that people pay their accountants a lot of money for, and not every single accountant actually gives you good information and advice. So today's video is essentially I'm sharing with you stuff that you'd ordinarily pay for, but I just thought, you know what? Let's just share it so that people can have access to this information and make the best decisions for themselves. Just to mention, I'm going to be using a spreadsheet that I created myself in order to be able to give you the illustrations for those three scenarios I mentioned, okay? If you're interested in that spreadsheet, feel free to get it for free. I'm going to put a link below for you to download a copy of it and a link above for you to go over and grab it for yourself and use it for yourself to work out these scenarios for your own personal circumstances. If you're really enjoying this video, hey, don't forget to hit the like button, hit the share and hit the subscribe, and share this video, please, with at least one other person who would absolutely find it useful as well. And the final thing to mention is that I'm actually a qualified chartered accountant. I'm also a former chief financial officer. So I'm sharing this stuff based on my own personal and professional experience. But do please absolutely make sure that you take your own personal advice. Go and seek the advice of your own accountant or your own advisor in order to be able to make the best decisions for yourself. In short, please see this video as education and take what you can from it, and please show some love for the work that has gone into making today's video. Okay guys, so I've created a deck here to make this super efficient because we've got so much to cover, okay? So here's an agenda of what we're going to cover today. We're going to look at corporation tax and allowable expenses. So all these sections are things you need to look at first before you decide how much you should pay yourself as a company director. So we're going to look at allowable expenses, we're going to look at pensions, company pensions, income tax, national insurance, dividends, which is a big section. Then I'm going to reveal the director's salary that I suggest that you should pay yourself in this current tax year, the most tax efficient amount. And then we're going to look at some really, really important scenarios, three of them specifically, which I'm going to walk you through. Okay, right. So corporation tax first. This is taxes payable by the company on net profits. Okay, so you have to have made profits first before you actually become eligible to pay corporation tax. And of course, tied to making profits is the fact that you can deduct some business expenses. And we're going to be covering what those are very shortly. Corporation tax rate, as at the time of making this video for 2021/2022, is at 19%. Okay. The budget recently, they made it clear that this is forecast to change in the year 2023 to 2024 to 25%, although it will stay at 19% for what's known as the small profits rate, okay? Now, before you pay corporation tax, as I mentioned earlier, you can then deduct what's known as your allowable expenses. Now, allowable expenses are expenses that are wholly and exclusively for business purposes, okay? And that helps you to reduce your corporation tax, okay? Now, let's look at what allowable expenses are. I've got a few examples of ones that are really popular, okay? So what are these? These are things that you deduct first before you get to your profit before tax, And then you deduct your tax to get your profit after tax, which is what you then get to pay your dividends from. So allowable expenses examples are salaries, so that's excluding any dividends. So this is the salary you might pay yourself. Pensions, and this is a big one, we're going to be covering that in detail. Your home office, if you're using your home office as part of your business, you're allowed £6 per week as at the current tax year, or £312 per year. Mobile phones, landlines, and broadbands. Now, if you've got a phone contract, you're allowed to have a phone to run your business. Everything has to be wholly and exclusively for the business. So you have to have it in your business's name for it to count, stuff like that. Same applies to your broadband. You essentially have to prove that the expenses relate to your business. Now, if you've got a car or a van, things like that, and you use your car to go temporarily to a place of work and back, you can claim back some of the fuel related to that. So 45p on the first 10,000 miles, 25p over 10,000 miles. Next, you've got equipment, so you can claim for things such as computers, softwares, and consumables that relate to you running your business. Advertising, marketing, PR, of course, you need these to be able to attract some leads and bring those leads into your business. These, provided they are wholly and exclusively for your business, are tax deductible expenses. And then, of course, you've got accountancy fees, which again are tax deductible. So there are others, by the way, allowable expenses, and many others, but I've just shown some of them here to give you an idea of what we need to deduct before we even get to the profits before tax. Now, let's talk company pensions, okay? Now, there are two groups of pensions. You've got either company pensions or personal pensions. Now, if you are a director of your own limited company, you can create for yourself a company pension. And that company pension can then go ahead and make a pension contribution into your own bank account, okay, into your own pension specifically, to be clear, to your own pension that the company has set up for you. You can pay in up to £40,000 per year per director, okay? So if you are, say, two directors, as an example, if you've got a husband and wife team, you can pay in up to £80,000 per year per director. But what's really key about this is that it's zero corporation tax to pay on that, okay? So, you know, it comes out before you've even got to the line where you get to the profit before tax for a business, okay? So that saves you that 19% that you would have paid for corporation tax. Also, you don't pay any employers' national insurance related to that because you are paying that into a business. So this is a really, really important allowable expense, and one that many people actually do not take advantage of. We're going to be covering a bit more about it when we look at those three scenarios later on in this video, okay? Now, the key thing to note is that the pension amount that you pay in from your company must not exceed the current company's year income. So the current year's income for the company, if you're making pension contributions into your pension from the business, the amount you pay in should not exceed the amounts that you've generated in income for the year, because otherwise it starts to look a bit suspicious. Just an FYI on that. Because now we've covered pensions, let's now look at income tax. So this is tax related to you as an individual, as the director of your limited company. So now, this is tax that you would pay on income that you earn through your limited company. So that's excluding dividends. This is tax that you pay on things such as the salary that you are generating from your business. Now, the key thing to note is that you get a tax-free element. So everybody gets a personal allowance every year of £12,570 as of the current tax year of 2021 to 2022. This was fixed in the recent budget to carry on till the 5th of April 2026. So we're expecting this personal allowance of £12,570 to remain the same until that date in 2026. And the key thing to note is that with income tax, you have various income tax thresholds, okay? So for above that tax-free amount you get of £12,570, you also have to then start to pay tax when you start to earn above that level. So you pay tax at 20%. Between that amount and up to £50,270, you then pay a 40% tax if you earn above £50,000. all the way to 150, and then there's an additional rate of 45% above £150,000. Now, these thresholds matter when we start to look at dividends in a little bit. Now, let's look at national insurance, because this really, really matters when you are deciding what you should pay yourself as a company director, okay? Now, there are 3 thresholds when you look at national insurance specifically. And the key thing to note, this is why it matters, because you might say to yourself, well, why don't I just pay myself the personal allowance? Well, the reason we are looking at national insurance is because all the 3 thresholds of national insurance all fall below the personal allowance threshold of £12,570. So in order for us to decide how much you should pay yourself tax efficiently from your limited company, we need to pay close attention to national insurance to make sure that you're paying yourself the right amount, such that you still get other benefits such as your state pension. So the first threshold is what's known as the lower earnings limit, the LEL. So in order to get the state pension, you should definitely make sure you pay yourself above that lower earnings limit. We're going to see what that number is in a minute. The second threshold is what's known as the national insurance primary threshold. Now, this one relates to employees specifically, okay? And in order for you to pay no national insurance as a director of a limited company, you need to pay yourself a salary below this particular threshold. And again, we're going to see what that number is in a minute. And the third category of the third threshold for national insurance is one known as the national insurance secondary threshold. And in order for your company not to pay any employers NIC, so NI related to the company itself, in order not to pay any of that from the company itself, you should pay yourself a salary below this particular national insurance threshold. Okay, so we've got 3 thresholds as outlined here, and the bits I've underlined here in this kind of reddish color is what you need to pay very close attention to. Now, here are the thresholds specifically. So threshold 1 is £6,240 per year, according to this current tax year. Threshold 2 is £9,568 per year. This relates to employees NI, and threshold 3 relating to the employer is £8,840 per year. Keep an eye on that number. It's a very important number. So what that means, in order for you to pay yourself efficiently within your limited company as a director, you should definitely pay yourself minimum this amount here for number 1. So for 0 NI at all, pay yourself a salary above number 1, so above £6,240, below number 2, so below £9,568 per year, but also below number 3, below £8,840, okay? If you're able to do that, then you will find that you are now close to paying yourself a super tax efficient salary. Now, more on national insurance is worth mentioning that if you earn above these particular thresholds that we mentioned here, you will pay NI at different rates. So if you earn, say, above as an employee, if you earned above the primary threshold, you will pay NI at 12%, between 9,568 and 50,000. Okay, just worth mentioning that. And for the employer's NIC, if you earn a salary above 8,840, you would pay employer's NIC, i.e. the business would pay this at 13.8%. And that just carries on. You know, no matter how much you're earning above that threshold of 8,840, the business will pay 13.8% employer's NIC. So essentially, there is a potential hit of 25.8%, being the 12% employee NI and the 13.8 employer's NIC, which is why what you choose to pay yourself as a company director does matter, because there is an amount you can pay yourself without the need to pay this additional 25.8% tax. And let's talk dividends, okay? This is a big one. So dividends are paid out of current year profits after corporation tax, which is a tax you pay on profits from a company, okay? Dividends are also paid from prior year retained earnings from your balance sheet, okay? So that's worth mentioning. So if you've been building up some profits over the years, dividends can be paid from that as well, okay? Dividends are only payable to shareholders of a company, so not just directors, but you have to be a shareholder to earn a dividend. You also get, in addition to a normal allowance every year, you get a dividend allowance of £2,000 per year as at this very moment. It used to be a lot more than that, but currently it's at £2,000 per year. Now, you can use your unused personal allowance from your £12,570 towards dividends as well. Okay, so here's an example of that. Say, for example, you paid yourself a salary of £8,500 per year. You would still have £4,070 of your personal allowance left, i.e. your £12,570 less that £8,500 you paid yourself as a salary, which would mean your tax-free dividends would be boosted by this extra 4070 here. So it'd be 4070 plus your regular £2,000. So you'd have £6,070 that you can use towards tax-free dividends in a specific tax year. Now we've covered dividends, let's mention briefly the different dividend rates, okay? So dividends follow the same income thresholds as you would salary. So notice those thresholds, 14,571, which is your 12,570 plus your £2,000, so that's 14,570. You pay the basic rate up to £50,270. You pay only 7.5% tax. Okay, this is so important. Above that, up to 150,000, you pay 32.5% if you're earning dividends. And beyond that, above 150,000, you pay 38.1% dividends. Notice how different these rates are to the rates that we mentioned earlier if you're somebody who is earning a salary instead of dividends. And these rates will matter when we come to look at those comparisons later on. Now, at this stage of this video, I'd love to ask you guys, if you're really enjoying this video, please hit the like, hit the share with somebody else who you think might really enjoy this video and take value from it. And please hit that subscribe button because it really helps to support us here on this very channel. Okay, so this is the bit that most people have probably been waiting for, which is where we look at the suggested director's salary for this current tax year of 2021, okay? Now, as mentioned earlier, you have a personal allowance as a director, 14,570, which are your two allowances if you earn both salary and dividends. Although you can take £12,570 as a salary, given it's your personal allowance, we would not recommend doing that if you are somebody who does not want to pay employees NI or employers NI. Okay, so given that information, for maximum tax efficiency such that you get access to your state pension, we'd recommend paying yourself a salary above the lower earnings limit of NI, but below the secondary threshold, which is the threshold for companies. And the suggested salary for absolute tax efficiency in this particular tax year is £8,840 per year, which works out to be £737 per month. So if you paid yourself this salary, you will find that you pay absolutely no tax, no income tax, no employees NI, and no employers NIC. Okay, remember, you've taken quite a small salary here relative to what people might take ordinarily, but it's a tax efficient salary to pay yourself. And the rest you can then explore paying yourself via dividends. Okay, so let's now look at three scenarios of income at £50,000. Okay, so we're assuming here that you are a director of a company and this is your only source of income. Okay, your company's made some profits and you are now deciding how best to pay yourself a salary and dividend from that particular business. Okay, so I've created a simple spreadsheet here to give you a full demo of what this could look like for you potentially. So just to show you how this spreadsheet's working, at the top here are all the inputs, so showing you all the various rates, employers NI and so on. And then I've created three different tabs to show us our three scenarios. And then at the end, we've got a comparison tab. So for scenario one is for a director who is looking to earn dividend and salary in a particular year. Let's assume that you've got here profit before tax of £50,000 from your business. This is after most of your expenses, except for pensions and salary, okay? Now, let's assume that you are somebody who says, yep, I now, given that suggested salary of 8,840, I'm now going to pay myself that salary of 8,840 in this tax year, okay? If you did that, you would see that your updated profit before tax would be that amount of 50,000 less the salary you're paying yourself because it's a tax deductible expense. And once you do that, you see the updated salary of £41,160. Now, out of that updated profit before tax has to come tax at 19%. Okay, this is the corporation tax rate at this very moment. That gives us a profit after tax of £33,340, which is now available for you as a director to draw as dividends. Okay, now out of that, given that you had £12,570 per year of personal allowances, and you've used some of it here towards your salary, you would then have only £3,730 of it left over to use towards dividends, tax-free, so 0%, as well as your £2,000 per year of dividends, tax-free as well at 0%, giving us £27,610, which you then pay tax on at 7.5%, okay? Now, the tax on 7.5% of that number gives you this £2,071, just worth noting that, okay? Now, what I've done on the right-hand side here is then given us a summary. So I've given us a director's summary of what your numbers could look like, and then the company's summary of what the company's numbers could look like. So if you see in summary here for this scenario, salary at 0% is 8840. You obviously pay nothing else at 20% because you only took your salary below the personal allowance limit. Notice at this level, you pay no income tax, no employees NI, and no employers NIC, okay? In addition to that, you use the rest of your personal allowance towards dividends, so you pay nothing on that at all, 5730, which is the sum of these two numbers here. And in addition to that, the rest of the money you're taking from the company, from your profits after tax, is 27,610, which gives you a total amount earned of £42,180. And of course, out of that, you pay dividends tax of 7.5%, which is this number we picked up here, giving you a total take-home pay of £40,109, which makes up 80.22% of the £50,000 that we started with in the first place. So quite a large take-home pay here. And then I've given a bit of a summary here of what the situation looks like for a company. You had profit before tax here, then you had the tax, and then you had profit after tax, which then got distributed, okay? So take note of that number there, the take-home pay for somebody who's taking both dividends and salary, okay? Now, in this scenario here, second one, we're looking at scenario 2 of pensions plus dividends plus salary. Let's say you decided, for example, well, what if I decided to take £40,000 as my pensions, okay? I've put that 0 there just to kind of show you what that looks like initially. Imagine you said to yourself, out of my profits, because I'm allowed a pension, I can pay up to 40,000 in. What if I did that? And I chose £40,000 in a year. Look at what that does. The 50K profit before tax gets reduced by that 40,000. In addition to that, you then take that tax efficient salary we mentioned of 8840. Notice what happens. Because you've taken that, you don't pay any employers NI, you don't pay any employees NI. In addition to that, you have very little left over subject to tax. And of course, you pay tax on that to give you this figure at the end. And that then gives you a summary here on the right-hand side. For a director who takes this particular approach of putting a lot of their money in their pensions, it's absolutely tax efficient. You can see that they're taking home 99.56% of their money, of that £50,000, okay? Because they put the vast majority of it into pensions, which they can't access to retirement, worth mentioning that, okay? And they've taken some of it as dividends, they've taken some as salary, and for all of those, they're paying no tax at all, okay? But the business does pay corporation tax for some of the money which is left over after taking some pensions and taking your salary and your dividends as tax efficiently as possible, okay? So this is scenario 2. Again, take a note of that number there. You are ineffectively taking home most of your money here, okay? You should really, really think about this one. This scenario would suit somebody who already has some savings that they can access, maybe in their stocks and shares ISA, or maybe in an accessible savings account, such that they can afford to put this much money into their pensions and not have to worry about it until they retire, okay? Now, let's look at scenario 3. And scenario 3 is where somebody says, you know what? I'm not going to take any dividends. I'm just going to take salary from my business, okay? So this business, again, they've got £50,000 of profit before tax, okay? Now, in order to take that, if you wanted to take all of that, let's say you wanted to take it all as salary, that's £50,000, you notice that you can do that, except what you have as a problem here is you have employers' NI to pay, okay? You have employees' NI to pay, and of course you have tax at the basic rate of 20%. Now, because you've got employers' NIC to pay in a company, you essentially put the company into a loss-making position because you've taken everything out of it without actually leaving some of it in there to be able to pay for that NI, okay? So let's just say hypothetically that we wanted it to be able to pay for the NI completely. We will choose a number such as this number here, okay? A number just above £45,000. Why have we done that? Such that the employer's NI bit, which is 13.8%, that bit would essentially leave us in a position where the profit before tax is completely zero. So imagine you are the person who's made profit here of 50,000. You then want to take 45,000 of it as salary. You also want to pay the employer's NI without any problems. Altogether, that sums to zero. Okay, so there's no corporation tax to pay here. You see here that there is employees' NI and there's a basic rate of tax. But look on this right-hand side though, at what this looks like. Okay, so you've taken the full thing, your personal allowance at 12,570. In addition, you've taken some more as salary at 20% tax, which a lot of people do. That gives you a total earned salary of £45,009, okay? Out of that, you pay employees' NI. Out of that, you pay your tax at the basic rate, leaving you with a net take-home pay of £34,268. But notice the vast difference, how that compares. 34,000 compares to what we had in this one here, this scenario here, where we had £40,000 being what you took home, okay? So here you got a full salary scenario with no dividends being taken. £34,268 would be your take-home pay. Notice you've got no corporation tax to pay because you've taken all your money. And all that was left was an amount you left over there for you to be able to pay the employer's NIC, okay? Now let's look at this comparison here because I've done a bit of a summary for us to see what the real impact of all this is. So scenario 1 is dividends and salary. Scenario 2 is pensions, dividends, and salary. And scenario 3 is salary only. You can see that for scenario 1, which is absolutely tax efficient, from the 50,000, your take-home pay is £40,109. For scenario 2, which is the most extreme scenario because you're putting a lot of your money in pensions, up to £40,000, which is the annual limit, you can see that you're pretty much taking all the money. You're pretty much taking all the 50,000, which was your profit. You're taking £49,780 of it because you've put most of it into pensions. You've taken a super tax efficient salary of 8840, and you've taken the remainder as dividends. You can see there that the verdict is that you are way better off than just a dividend and salary if you started paying some of it into a pension from a company directly. Not from your net income, but from the company directly through a company pension scheme. And then the third scenario is a salary-only scenario where, again, 50,000, but given you had employers and NI to pay, what you could really take from the company was £45,009, but it's not that tax efficient because you've had a lot of tax to pay at 20%, as well as a lot of employees NI to pay, which would mean that your take-home pay here will be £34,268 in that year, leaving you £5,841 worse off compared to the dividend plus salary scenario where you would have taken home £40,109. So there you have it, guys. There's a summary of 3 possible scenarios of ways that you can explore to withdraw money from your limited company legally, but doing it as tax efficiently as possible. Guys, if you really enjoyed today's video and appreciate all the effort that's gone into making it, please hit the subscribe button and show us some love here at The Humble Penny. Also, please hit the like button because that just helps to get this video promoted to so many more people. And don't forget to share this video with one other person who you think will find today's video very useful. I'm going to be in the comments, so jump in there and feel free to ask me any questions, and I'll be more than happy to jump in there and answer your questions for you, okay? Final thing to say is, don't forget to make sure that you are paying the right taxes for your personal circumstances, and do please make sure you seek professional advice in making your own decisions. All right, guys, thanks so much for watching today's video, guys, and as ever, in all things, be thankful and seek joy. Take care, and bye for now.